Welcome to Own Your Zone podcast, where we feature venture capitalists, innovators, angels, and other investors who create positive impact globally. Now, let's get started with the show.
Welcome to Own Your Zone, where we feature venture capitalists, innovators, angels, and other investors who create positive impact globally. I'm JiNan, Glasgow, George. I'm host of this show, and I'm also founder of Neo IP law firm in intellectual property law and patent forecast software. Neo IP is an IP firm that takes a data-driven approach, a holistic approach to creating intellectual property assets. We help innovators transform society for good by transforming their ideas into assets that multiply their business and connecting them to resources, which is very often another company, another person, another fund. We believe that every company should have an IP strategy, not just file. And for investors, we de-risk investment through patent forecasting. Each of our podcast episodes is dedicated to this conversation tied to our mission, and it's a moment for us to connect the dots globally with resonance and alignment with innovators. I'm so delighted today to have Charles Hudson on the show. Welcome, Charles.
Oh, thank you so much for having me.
Super. I know you are an operator, an investor, you manage a fund, Precursor Ventures, and we met in Riyadh, which is a place of great innovation today. Thanks again for joining and welcome.
My pleasure. My pleasure.
Tell us a little bit about your origin story, how you got started and how you've come to Precursor Ventures today.
Yeah, I'll try to give you the somewhat condensed version. So I'm originally from Michigan, but I moved to Northern California about 25 years ago. And I didn't know anything about technology. My mother's an attorney. My dad worked in the auto industry. But I'd always had little businesses in high school. Landscaping business, paper route, a bunch of businesses. And I graduated from college kind of right into the tech 1.0 bubble of the late 90s.
Yeah.
And I was totally enthralled by like the transformative power of what the internet was going to do for business. And I said, I'm going to make the internet my career until I get bored with it. And here I am many years later, still working in tech. And so I worked for I interned for a tech company while I was in college. Through that job, I met a woman who became a mentor, and her husband ran a venture capital fund. And he happened to be hiring as I was graduating. And so I ended up working for In-Q-Tel, the CIA's venture capital fund, for about 3.5, almost 4 years out of undergrad. Great foundational venture experience. Went back to business school at Stanford and came out of it thinking I wanted to try my hand at entrepreneurship and being part of the startup community. So worked for a handful of startups, had a couple of my own, tried out the big company life and realized that really wasn't for me. And then ultimately ended up joining a venture firm called Uncork, which at the time was called SoftTech. And I was a partner there for about 4 years. And then kind of had this desire to start my own venture firm, really because I felt like there was this one segment of entrepreneurs who really weren't getting the attention and time that I thought they deserved.
Okay.
But I think in general, like venture capitalists are pretty good at funding people that we know socially and professionally. That feels kind of low risk. And we're pretty good at funding people who've built businesses that have some level of traction to them. If you relax those two constraints, I don't know that we're so great at funding people we don't know who don't have traction. I personally enjoy investing that way and wanted a firm where that was sort of the first class mission of the firm, not like a side project, not like a hobby.
Yeah, that's a fair point. Ago. You know that there's so much inertia from that idea to reality and getting traction in the market. It's such a heavy lift, and yet that's big gains to go from 0 to 1 million, 0 to 10 million. Like it's a heavy lift, but the people who have a vision and can be surrounded by mentors, even if they haven't done it, can be successful. And it's so delightful to hear that you've taken that early stage position. Managing venture, though, it isn't easy, right? There's the power rule, right? There's an expectation that there's high failure. I don't agree with that personally. I like to take other data-driven approaches and also engage to help ensure success. But how do you think about that from managing this venture fund today?
I think the power law it's real. But, I think on the one hand, I think if you talk about venture, like it's a spreadsheet business, it's very easy to be, I would say, kind of, what's the right word? It's easy to just say, oh, well, a lot of these companies are going to fail. And like, that's life. But when you work with founders and you deal with people, like those failures are like humans. Yeah. Those are humans whose companies and dreams and hopes like come to an end. And it's hard to just accept that that's the natural state of affairs. So, we have 83 companies in our first fund. My guess is the top 10% will deliver 85% of all the returns in that fund. And my guess is the top 5% of the top half of that top 10% will probably be 75% of the financial returns in that fund. And it doesn't mean, and what I tell people is like the fact that a company doesn't return our fund and doesn't generate a ton of cash doesn't mean that company didn't matter. And doesn't mean that that founder didn't matter. And doesn't mean that just because they're not financially a success that we should treat them any differently. It just means we're probably going to have a shorter working relationship with that team because they're not going to get all the way.
You have to focus your energy, your time, your money where it can give the most return. And yet a lot of companies don't have that venture trajectory and yet still create jobs, still create positive impact. But I think it's interesting the way that you put that is like you just have a shorter working relationship with them. Mm-hmm. Do you find the soft landing to be a possibility for many of them?
Yes. I think it's interesting, JiNan. I tell everyone the best time to build relationships for a soft landing is a year or two before you need them.
Yeah.
And I'd say the founders and the problem I often find is that kind of relationship building, it's important, but it's almost never urgent. Ironically, it's only urgent when you really need to sell the company.
Yeah.
And I tell them these conversations will be a lot easier if we find ourselves needing to sell the company. Or in one case, we were talking to a buyer where we're going to end up being the acquirer instead of the acquiree. Like our relative fortunes changed. And the person's like, well, I'm really glad I got to know this company because like we're going to now buy them. And so I tell people like it's really important to get to know people if you want to have that soft landing as an option, because it's very hard to buy a stranger. And in this environment, I think a lot of founders are realizing, hey, our company doesn't have as bright of a future as we thought in a few years ago. And so I'm finding a lot more receptivity around the soft landing.
Yeah.
Sure beats failure.
It sure does. And a total write down. So let's back up a couple years. It's a different world today than 2021, 2022. 2021 was the highest raise for venture in its history, and 2022 was on par to beat that through September of that year. And yet we also saw company valuations kind of moving the same direction. Mm-hmm. In some cases, really outpacing what was reasonable. What are your thoughts on what we saw and where we are now?
I think venture is a bunch of feedback loops. And I think one feedback loop we got was, wow, the public markets love SaaS companies.
Yeah.
And investors in the public market are willing to give you very, very high multiples on future cash flows if you're growing quickly. And so that optimism translated down into venture land. Yeah. And, if public companies were trading at 20 times forward revenue, private companies, in some cases, were getting valued at 100 times private company revenue. And there was a logic there, faulty as it was, which is that, hey, these private companies are growing even faster than their public market peers. So there probably is room to be more aggressive on multiples. But like these feedback loops work in both directions.
Mm-hmm.
Then we went from 20 times revenue multiples to 5 times revenue multiples. And, that impacted private companies too. And I think we sort of forgot that being a multi-billion-dollar private company public company is a very hard thing to achieve. Doesn't happen that often.
Yeah.
And for 3 or 4 years, it felt like it was really easy. And in a world where it feels easy to get to $1 billion public valuation, it's very tempting to think every company you back can get there. I think we're back to a more sober, realistic time where people are like, hey, it's really hard to do this.
Yeah.
It's really hard to build a business that generates a couple $100 million in revenue with reasonably good margins and can survive the scrutiny of being a public company.
Amen. Agreeing with that completely.
Yeah.
Completely. I think it's a fair point, though, in the times where we are requiring improved efficiency, improved productivity, there's a keen space for B2B software to be that solution. And so it does still seem like it's a good time to be investing in these software companies.
I think the other thing we forgot is that part of what makes startups special is that they can do more with less. Fewer people, less money, less bureaucracy. And in a lot of ways, in the last few years, startups were doing less with more instead of more with less.
Yeah.
Lots of people, lots of expenditure, and like the revenue coming out the other end wasn't commensurate with the investment. And I'm personally happy that we're moving back to a world where I think most startup founders realize like their job is to do more with less.
Yeah. That's a good mantra for today and going forward, for sure, for sure. We're seeing a lot also in the software space with a lot of optimism on AI and the role that AI will play in giving sort of this increasing efficiency, this increase in productivity, maybe doing more with less. What are your thoughts on that?
Well, I thought it'd be a while before we saw another enthusiasm boom like we did a few years ago. And turns out the answer was we just needed to wait for AI. I think there's a lot of enthusiasm within the investor community around what AI could do. And I was telling my friends, I think part of this is because it feels so tangible. You can just go to ChatGPT and type something in and get a response in a way that some of the other things of maybe crypto or Web3 felt a little bit harder to access. The AI revolution feels like it's accessible to everybody. It feels like it's going to impact almost every area of software. The question I have is like, but what businesses can you build around AI, particularly in a world where it seems like everybody's utilizing the same technology in the same way? Historically, that's been a hard way to build a defensible business.
Yeah.
Usually you've got to do something unique or proprietary or have like a special insight. And right now it feels like everybody's tapping into the same core set of engines. So I continue to wonder, not at all about what impact AI is going to have on software, but how do you capture some of that value as an investor? That part is still kind of unclear to me, to be honest.
Yeah, and you raise a really good point. While there are so many tools available to so many people today, I mean, even, we walk around with compute in our pockets, in our mobile phones, our smartphones, that far surpasses early computers and servers for NASA. And yet, what are we doing to really deploy those effectively? So I think that there is a question of effective application of all the resources that it seems everyone has at their disposal. The point you raised that I love as we work in intellectual property and innovation is differentiation. How unique are you? There are known components, but if you can combine those known components in a new way, a novel way, a way that is advantageous, that wasn't obvious, then you've got that differentiation that can translate into exclusive rights of IP. I will just maybe stimulate this a bit. A lot of software investors, a lot of VCs that I've talked with, even some locally, they're not maybe anti-patent, but aren't pro-patent for sure. And yet we see from the statistics last year, 2022, in the US, of all issued granted patents in the US, 65% were software related inventions. And all big tech, all big software is investing at high rates in intellectual property here.
Yeah.
So what are your thoughts about the role of intellectual property and differentiation for the companies that you choose to invest in?
I think differentiation is something I always am looking for when we invest. We don't always find it. We will sometimes invest in companies where I'm just like, hey, there's like not a lot of differentiation here. I just think it makes it harder as a business. You've got to lean on other things like brand or relationships to grow. I think with startups, patents are interesting. Occasionally we have companies, particularly on the hardware side, I'd say it's a different world. Our hardware companies are very cognizant of the value of their IP, and they make pretty significant investments in protecting and documenting their inventions. I think in our software companies, the harder thing is most of them aren't really resourced to defend patents. And I do think there is a sort of like somewhere along the lines, VCs, I think we maybe lost the thread from like startups who would come to me like, we have this patent. And I'm like, well, the patent's may be valuable, but you've got to defend it. You've got to be around. Your company's got to like make it. And I think in some ways, VCs sort of reacted to startups coming up. It's like, I got a patent saying patents aren't worth anything, which is actually not true.
Yeah.
And I think there's this more nuanced thing, which is that like, if you've really developed something that's novel and unique, you should protect it. And patents are one mechanism of protecting it, and like one we should consider along with trademark and other things. And but also it's like important that we also exploit the invention that you've built and use it for like maximum advantage.
Yeah. Yeah.
And I'd say like the level of patent literacy in our hardware companies is probably 10x what it is in our software companies.
Yeah. That's probably a fair point. We do see in software that a lot of developers, first of all, don't like to document things.
No, at all.
And so to have them go to put their hand to writing up a patent application, it's time that they do not seek out. They do not want to do that. We end up interviewing, I think, a lot more, just taking their inputs verbally than having them write things down in particular. But I've also noticed that they tend to have a lot of hand waving of like, yeah, that was nothing. When the standard is not their expertise,
right,
but the ordinary skill. And so I think they tend to diminish the innovativeness. They tend to diminish things that can give a clear advantage and be valuable. We often suggest that early stage companies aren't only patenting for themselves. Strategy, right, aligned with your business. And most companies will exit, not IPO. So we want to look at who are the big competitors in that space, what IP they have and what they do not have. And filling gaps for others means that you're not going to defend if they acquire you. They will use it against their big competition, right?
And that last thing you said is the only argument I found that many of the startup founders I talk to understand.
Yeah.
I'm like, someday when you're acquired, this is going to go into a broader patent portfolio that someone else is building, either for offensive or defensive purposes. And so don't worry about your exclusive ability to defend it. Think of this as like creating value for the company that you're building in the eyes of someone who might someday acquire you. That seems to work as an argument for documentation and patent process.
I have one more. I'll give you.
Yeah, okay, good.
Another one is that there is litigation. And so if you're in an area that is litigious, if you are sued by a competitor and you don't have any IP assets to cross-license, that's the number one way to settle. Cross-licensing. If you don't have valuable IP to cross-license, all you have is your cash. You never want to give your cash to your competition. So you get a good return on that as a defensive, I'm settling this dispute. So it's kind of a secondary way to think about how will I use these assets? So a super good conversation. I know that you're looking very closely, as you mentioned before, about we have to dig in a little. The diligence now in venture has returned. It's not just sort of a rock star name. Management team always matters, but what are you looking for as you dig in deeper on diligence with companies, even early stage?
I think I divide it into two buckets. One is corporate hygiene.
Yeah.
The other one is like claims and hypotheses. Most of the companies we invest in are pre-product market fit, pre-launch companies.
Yeah.
So I spend most of my time on corporate hygiene, and it never ceases to amaze me. I meet companies that did some local accelerator that took 20% of the company. And I'm like, that's not going to work. We're going to have to go back and fix that.
Yeah.
Or, oh, we had a third co-founder, but he left. He's cool. Like, don't worry about it. I'm like, I'm going to worry about it. We're going to make sure that person really, that their exit was well documented. Sometimes it's like, oh, my uncle's on the board. Why? Well, he's a real estate attorney and we wanted somebody who had some legal experience. I'm like, okay, your uncle's like not going to stay on the board of this. It just ends up being these, or sometimes like the company was like improperly incorporated. There's all of these like little hygiene things that are easy to fix at the time that we get involved and become much more difficult to address later. I think the other thing that we are going to see more of going forward is, I think for the most part, investors took founders at their word, and the majority of founders tell the truth. But the ones who lied, some of them lied pretty spectacularly in the last 5 years. And so if someone tells me that like such and such company is a customer, we should probably make sure that such and such company is actually a customer. And that understand like the way that the company is representing their relationship with that company is actually accurate. Mm-hmm. In many cases, it's not hard. It's like, hey, who's your point of contact at that company? And if they're squirrely about providing it, then
probably not
the contract.
The real thing. Yeah. Yeah.
And I think one of the challenges is when I started in venture back in the Stone Ages, everything we did was price rounds. And price rounds just gave you the room to do legal due diligence on companies and financial due diligence that like made it a lot harder to get away with stuff. And now the vast majority of investments we do are on safes.
Yeah.
And with safes, there is not really the same expectation that you're going to do legal due diligence because you're not really a current equity holder. And so I think there's things that like just don't get checked the way they used to. And I think it's partially just the fact that like the safe is designed to push all of that diligence into the future.
Good punt. Yeah, one of the things that we always look for are those contracts with the founders to the company. Every employee and every contractor that has non-disclosure, non-use, non-circumvent, non-solicitation, and non-compete if you can have it, and assignment.
Assignment, yeah. We spend a lot. Assignment is the thing we spend a lot of time making sure is in place.
Yeah, ensuring that it's there up front. And it is, you're right. Early stage, I do a lot of angel and early stage venture myself. And it's easy to fix. You can clean it up at the beginning and ensure that the protocols are there for sure. What are, I don't know if you can share anything that's really surprised you or caught you off guard in this year regarding any of your venture companies?
I will say this, and this is, I would say, a pleasant surprise. I really did feel like in the last few years, startups were spending too much money and had too many people on average for the task at hand. But in a world where like headcount was like a vanity metric that people wanted to see go up and capital was plentiful, I don't think people behaved irrationally in response to the environmental incentives.
Okay.
But I always felt like these companies would actually be better and faster with fewer people and like more constraints. And I've been pleasantly surprised by 24 of our portfolio companies that took really aggressive action on their burn rate and team size and got smaller and more efficient. And they're all like, I wish we'd done this a long time. And they're all like, oh, we have 8 people. What can we possibly get done with 4? I'm like, you'd be surprised. You'll get more done. The communications overhead for 4 people is a lot lower than it is for 8 people. And I would tell them, it's not that those people aren't good. It's that the things that they're working on aren't valuable for the company. And so it's not that you hired poorly, but like they're working on something that just doesn't matter anymore. And I've just been really pleasantly surprised by how many of those companies are like, we feel like we're just better. We're leaner, we're meaner, we're more focused. We can get stuff done faster. We're not worried about things that don't matter. We're more focused. And I felt deeply that that would be the result for a lot of our companies of making these cuts and adjustments to their budget. And I've been pleasantly surprised that it's turned out to be true in most, not all cases, in most cases.
Good. Yeah, burn rate is a hard thing to cut. I mean, hurts a little, right? Hurts a little for sure.
Mm-hmm.
And hard to let go of people that you've been working with, but it's a necessary thing. And it is a pleasant surprise to hear that you've had most companies working on that. Another area I want to ask you about, Charles, as we're winding up here, data. The value of data, how your private companies are thinking about data rights, data privacy, and how they monetize data.
I think, all of the changes on the mobile ad side that Apple pushed through really, I think, changed the way a lot of our portfolio companies think about data. I'd say the biggest change of all is I think there's a much higher value placed on high quality first party data.
Yeah.
It has so much more value environment where you can't just target people willy-nilly on the internet or on mobile phones. A lot of our portfolio companies have rethought their data strategy and said, assume we're moving towards a world becomes a much bigger part of the conversation than it was on the way up. How would you architect your product today? Also, there's certain types of data that maybe people would have thought there'll be a market for this. And maybe under a more strict privacy regime, our ability to monetize this data through partners will become more limited. So what do we do with it? And then you add on top AI, where like suddenly, we can use our customer data to train and feed our model and make our own product better. Data is at the heart of almost every conversation I have with our portfolio companies today. What do we do? And in some cases, like we don't want to store it like this way. We no longer want to store this data from like a risk and all kinds of like differing data standards across countries and regions. It's gotten way more complex than it used to be.
Yeah. And more valuable, I think. It's being deployed more. There's more insight and analytics. Yeah. That excites me a lot, the data and data valuation. Tell me one thing you're excited about for the rest of this year, 2023, and maybe one thing that scares you.
Interest rates scare me. They scare me. I just worry about this much tightening this quickly and like what it means for our economy. I think one thing I'm excited about is the quality of founders I've met this year is exceptionally high. And I think part of what I've seen is in previous downturns that I've worked where I've been in the tech industry, big tech companies have felt like a safe haven. And people have been like, I got laid off from my startup. I'm going to go get a job at a big tech company. That doesn't work in this environment. The big tech companies aren't safe havens. So it's been really interesting to me just to see more people try out entrepreneurship. And it doesn't have to be a venture-backed company.
Yeah.
I'm just excited to see more people start their own businesses where they can build a business that works for them and their family and their life and their goals. And I think it's healthy. I'm really optimistic that many people are going to discover like an entrepreneurial passion that they had that they didn't know about, where some of the dislocations in tech kind of gave them space to do so.
Yeah, the entrepreneurial mindset is always an exciting factor. I love to see it in the youngest and in the oldest. I think founders come in every age, but that is one thing that excites me for sure. It's been such a pleasure, Charles, to have you on the podcast today on Own Your Zone. Yeah. How can our listeners reach you or find you online, Charles?
Oh, yeah, I'm on Twitter some at Season. And then you can always just email me directly at charles@precursorvc.com.
Charles@precursorvc.com. Thank you so much, Charles. It's been a joy to talk with you. Thanks.
Thank you so much.
Thank you for listening to the Own Your Zone podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.